many in the silver space are far more bullish than I am, but I'm easily at $200 silver, and Egon is extremely bullish. And others who track the technicals and fundamentals aren't worried about trying to time this direction. They're just sitting back and letting the dollar shoot itself, and letting the US shoot itself, and letting paper money shoot itself. So we're just patiently waiting for silver and gold. Silver will move in a beta trade to gold in a bull market. Gold's bull market is just beginning. So we're not really too worried about the timing. There are forces, of course. We've seen backwardization in the futures market on silver with other indicators. It's very bullish on silver. We look at what SocGen traders are doing. I talk to traders what they're doing. Their long-term play here is very bullish. But again, if you're a swing trader, a day trader, an arbitrager, or precious metals, best of luck to you. I'm no help to you. And that is Ray Dalio's point. If you understand economics and history, you'll have no problem gaining faith in gold and silver. But certainly there can be headwinds and tailwinds as this process moves. None of these metals move in a straight line. But against the dollar, all commodities in general are just ripping in price because the dollar's gotten weaker. Basically, the exchange in New York ran out of the metals. They couldn't make delivery. It was unprecedented, both in gold and silver. What we were seeing with the ratio of demanded metals versus what was available was unprecedented. So they were running out of the metals to manipulate. So they had to use margin tricks to short or to put a permanent or try to put a boot to the silver price in particular. So the Comex is losing credibility to the SPYMEX and to the Shanghai exchange. So the flows and the trust and the metals are moving from west to east towards St. Petersburg and Shanghai. So that part of our tool that worked for decades to keep the price of gold and silver from embarrassing the dollar, again, it worked for decades. That really began to crack in 2024 and accelerate in 2025. So that was certainly a pillar that was cracking on the gold case, because gold has now made a fool out of the dollar, and it's going to make more of a fool of the dollar. The petrodollar, again, as I explained, was so critical to absorbing U.S. treasuries and U.S. dollars. That gave us tremendous power for half a century. That too is weakening. And so at the same time that you're seeing petrodollar and Comex cracks in the ice is getting thinner under those powers. You're just seeing a central bank that's expanded money, a balance sheet beyond recognition, but more important, public debt at 40 trillion, basically. The interest expense alone on our debt is now over $1 trillion.
The market claims gold is stable, yet delivery systems behind it are quietly losing credibility in real time. As Matthew Piepenburg points out here, physical demand is now overwhelming the paper mechanisms that kept precious metals suppressed for decades. Comex stress, rising Eastern accumulation, and collapsing petrodollar trust are not isolated events. They're signals of a monetary transition already underway. Most investors still think debt matters only when defaults happen. But the real destruction starts when confidence evaporates first. Next, Matthew Piepenburg reveals why central banks are buying gold aggressively while publicly defending fiat stability.
When I was a young kid playing baseball, Ronald Reagan was president, Volcker was at the Fed, and our public debt was 1 trillion. Now the interest expense on our public debt is 1 trillion. It's an extraordinary evolution in just the last 40 plus years while I've been growing up. So these things are hard math. They're stubborn facts. You can use pundits to talk about stimulus or accommodation or quantitative easing or support. You can use platitudes to hide math, but eventually the man on the street's going to feel it. Those of us who track markets can see right through this. We're doing a good job with platforms like yourself to educate people more about these boring topics. They can feel it. Now they can see it. But the public debt, the Comex cracks, and the petrodollar changes are all accelerating the hangover effect of living for years on too many martinis of easy money and deficit spending. The hangover is coming. It's here. We're literally seeing it right now. It's only just going to get worse, I'm afraid.
Oh, I hate terrible hangovers. Hey, Matt, I want to look at the board today, and I'll get Louis to bring up gold prices because it's doing exactly what drives precious metals investors crazy. I mean, we get a hot CPI print, 3.8%. Gold and silver dipping today because the paper market immediately prices higher rates and a stronger dollar. And then you just talked about that. Underneath that, physical demand. We got the buying from the central banks. There is that exchange credibility kind of moving in the opposite direction.
Washington still calls this a strong economy, even as interest payments alone now exceed the entire national debt from the Reagan era. According to Matthew Piepenburg, the disconnect between official optimism and fiscal reality is becoming impossible to hide beneath policy jargon and media spin. Gold dipping on hot CPI data looks bearish on the surface, but institutional physical buying underneath tells a very different story. Savers focused only on daily price swings are missing the deeper breakdown in sovereign credibility itself. Next, Matthew Piepenburg exposes why paper market reactions are now diverging sharply from physical metal demand worldwide.
Is this the real split now? Futures markets in New York and London still kind of trade on the Fed narrative, while physical markets in Shanghai and elsewhere are starting to trade distrust in the system.
Sure. No, it's when you just look at the time zones between New York, London, and then Shanghai. Shanghai gets the last say of the trade, and they get the more physical metals at the end of the day. And then London wakes up in the morning to see what Shanghai did with silver or gold. There's more physical metals now moving east and west. Doesn't mean that I can trust Shanghai or St. Petersburg not to do some tricks with the gold and silver prices, but they have a long-term interest in being a better broker, so to speak, than London or New York if they want to gain more trust among the BRICS and other nations. And many nations are leaving the fold of the West and the G7. But I think, there will always be manipulation on paper exchanges, and there will always be tricks and government interests that are more powerful than even the man on the street, or certainly even the man on Wall Street. But when you look at gold, we again at Von Greyer's are completely indifferent to the daily price. We certainly didn't reach peak gold in 2025. We're in the very first innings because the fundamentals just haven't changed. The central banks, it's their 15th straight month of gold buying. Gold was up in 2024 and 2025 predominantly, almost exclusively because of central bank buying. And that hasn't changed. The fears, the chaos around the world, none of this has stopped.
Markets still trade headlines during New York hours, but physical gold flows are increasingly being decided after Wall Street goes to sleep. What Matthew Piepenburg is highlighting is a structural shift where Eastern exchanges gain influence because they settle more real metal, not just leveraged contracts. 15 consecutive months of central bank buying tells you institutions are positioning for monetary distrust, not temporary inflation noise. Retail investors waiting for CNBC confirmation may discover too late that the migration away from Western financial dominance already happened quietly. Next, Matthew Piepenburg unravels why central banks trust gold more than the sovereign debt they publicly praise.
If anything, what we saw in the Q1 of 26 was a fire sale to buy more gold, which is what many of our clients are doing. The central banks are still the major players. Gold production is still, it's a limited supply. It's 3,800 tons last year, and nearly half of that went to central banks. But I think for those who just think us commodity folks in general, or gold investors in particular, are just gloom and doomers or cry wolfers, I understand that. I had that same view when I was a risk asset trader in the 90s and early 2000s. But let's just think about it. Since 2000, I was trading .com stocks, on the NASDAQ. Gold is up 1,580%. Its compounding annual growth rate since 2000 is 11%. And it's been positive 75% of that time. When you compare that extraordinary number to aggregate currencies since 2000, they've lost 94%. They have a negative 10% annual growth rate. And those currencies have only been positive 25% of the time in the last 2 decades, 25 years. So look, since 1971, right after I was born, US dollar versus commodities, the dollar has fallen 99% versus gold, 96% versus oil, 89% versus copper, I think 75 or 76% versus wheat. So folks, gold is not rising. Paper money is failing. And, look, these are math statements, not gold bug statements. US M2 went up 40% in 2 years during COVID, and then thereafter another 30%.
Most people think gold investors are chasing upside, when in reality they're trying to outrun currency erosion already baked into the system. Matthew Piepenburg's argument suggests the real story isn't gold appreciation. It's the long-term collapse in purchasing power across every major fiat currency since 1971. Nearly half of newly mined gold going directly to central banks should tell investors this isn't retail speculation anymore. Families sitting entirely in cash and bonds are absorbing silent losses every single year without recognizing the compounding damage. Next, Matthew Piepenburg reveals the hidden ratio institutional investors monitor instead of watching gold's daily dollar price.
So, the M2 gold price ratios are just beginning. We've seen nothing yet. Central bank reserves were 80% dollars and 10% gold years ago. Now the gold reserves have doubled at central banks, and the US dollar's gone from 80% to 56%. So, and even with FX reserves, the FX reserve assets are now greater in gold than they are in US treasuries. So we're not making this up. If you look at the signs and the flows, gold isn't going to replace the dollar, become a world reserve currency, or back the dollar again. We can talk about why. But gold is more honest and more trusted than the IOUs from Uncle Sam or the G7. And that's because we've blown that trust through decades of overspending and mouse clicking money to solve the problem and put a Band-Aid on a knife wound. But the data is extraordinarily obvious. And again, there are many ratios: gold to Dow, gold to S&P, market price of official gold to foreign held US treasuries, gold reserves as a percentage of US debt. Blah, blah, blah. We can go on and on to the data and the charts, and they're fascinating, but they're boring to most listeners, and I understand that. But it's very simple. Cut through all the fugazi of debt and fog and war and headlines and tariffs and Comex. It's really simple. We're in debt beyond imagination. It's unsustainable. We've debased the currency to buy time, buy votes, and buy temporary prosperity, and hand that permanent ruin to the man and woman on the street. It's absolutely criminal.
Yeah. You kind of brought up money supply there.
The Fed keeps defending the dollar publicly, while central banks steadily reduce dollar reserves behind closed doors. This is where Matthew Piepenburg's thesis shifts from inflation fear into a deeper crisis of monetary trust and reserve credibility. Gold, now surpassing US Treasuries' inside reserve allocations, is not symbolic. It's a measurable repositioning away from sovereign IOUs toward hard collateral. Investors waiting for an official announcement will miss the fact that institutions already acted years earlier through reserve diversification and physical accumulation. Next, Matthew Piepenburg exposes the monetary math that makes further currency debasement politically unavoidable.
Frame gold against it for us, not the price, because if US M2 kind of exploded after COVID and gold is simply marking down the purchase power of paper, should investors stop asking how high can gold go and maybe start asking, how much further can currency units be diluted? I mean, what does gold look like when measured against M2 and deficits and debt service instead of dollars?
Right, that's exactly a key point, Jeremy. When people look at the gold price, and when we were in Vancouver, it was just euphoric. The gold, silver it was scary. It moved too fast. And they were just, how can gold be at 5,500? How can silver be over 120 or 100? This is crazy. This must be a bubble. This is madness. And I understood that. I certainly could understand that sentiment. But I think what they were missing and what they didn't want to see, the cognitive dissonance was, what they didn't want to see is, how can paper money, Canadian, Australian, American dollars, have gotten this weak? Because it wasn't the gold and silver were in an irrational bubble. They were in a bull market because paper money is in a secular bear market thanks to our policymakers. So, and you can get into the, again, way too boring, M2 versus M0 money supply. Does QE really go into the system and the velocity of money? Is QE really inflationary? It's a very boring debate. It's important, but your eyes will glaze over on it. But the bottom line is you can't expand the Fed balance sheet to $9 trillion.
Markets keep calling gold a bubble, while ignoring the far larger bubble sitting inside fiat currency itself. As Matthew Piepenburg points out here, investors obsessed with gold's rising price are missing the more important reality. Paper purchasing power has been collapsing underneath them for years. A $9 trillion Fed balance sheet didn't create prosperity. It temporarily disguised systemic debt saturation through liquidity expansion. The danger for long-term savers isn't volatility in metals, but holding assets denominated entirely in currencies being diluted to sustain political stability. Next, Matthew Piepenburg reveals why the so-called debasement trade is no longer a fringe theory on Wall Street.
expand credit at the banking system and bring M2 money supply in without debasing the currency. And you can argue it 5 ways to Sunday, but we've printed too much money. We've added too much water to the wine of the US dollar, and we've debased it. It's now, it literally got a name, the debasement trade, officially on Wall Street. But, when M2 money supply expands that dramatically in a period of such a short amount of time, again, M2 to gold price, I think the ratio is around 4.6 now. In the 80s, it was as low as 2.5. And believe me, I don't care when or how, whether they QT or go right to QE, whatever semantics they want to use, we're going to see more liquidity, more money printing. It's going to continue. So the ratio of M2 to gold is going to continue to compress, which means the gold price is going to continue to rise only because the money supply is exorbitant and frankly fatal in terms of purchasing power for the US dollar or any paper currency. And again, we can look at the charts, we can do the math and go over the ratios, but I think we all feel it, we all see it. Gold stackers have never thought gold was going to become more shiny, more use for jewelry, or more use for fillings. They just knew the paper dollar was killing itself. And even the Chinese with their yuan see it. But as, the Chinese Book of War, Art of War, Sun Tzu, when your enemy is shooting itself in the foot, just let it keep doing it. So
Wall Street publicly debates inflation risks while privately institutionalizing what traders now openly call the debasement trade. According to Matthew Piepenburg, the real issue is not whether QE returns, but whether the system can survive politically without more liquidity injections. The M2 to gold ratio remains far above historic extremes, signaling that monetary expansion still has not fully repriced against hard assets. Investors holding large cash positions may discover their portfolio losses come slowly through purchasing power destruction rather than sudden market crashes. Next, Matthew Piepenburg exposes why foreign governments are quietly benefiting from America's accelerating currency dilution.
So the U.S. its public debt levels exacerbated by the COVID policies, which were well beyond necessary at a certain point, and now exacerbated by war costs and a $1.5 trillion budget for 27. China, which has a paper currency, just sits back and watches the U.S. shoot itself over and over in the foot, the chest, and the elbow. And they're not going to have a better yuan, but they're going to have more gold in their trade settlements. And they are playing 3D chess while we dial up QE or QT or debate the Fed funds rate versus the long end of the curve. They're just watching us do what history has always done, watch nations destroy themselves with currency debasement and war.
Yeah. Hey, I'm looking at these numbers today on CPI and some of the manufacturing too. I mean, I just want to talk about silver for a minute because obviously it has that massive structural deficit story, but it's also an industrial metal. If high interest rates finally break the economy and we go into a deep recession, usually manufacturing demand gets hit. What are your thoughts here? I mean, why wouldn't an economic kind of slowdown crush silver before the monetary thesis has time to play out here?
Well, I mean, there are headwinds and tailwinds on any ocean trip, whether you're heading, from east or west, north or south off of any peninsula. You'll see different currents and different winds. You could see industrial demand for silver weaken at the same time that it's the supply and demand mismatch.
The Fed says tightening policy restores discipline, yet deficit spending and war financing continue expanding at emergency levels anyway. What Matthew Piepenburg is highlighting is that geopolitical rivals no longer need to defeat the dollar directly. They simply need to watch Washington weaken its own currency credibility through endless debt issuance. China accumulating more gold in settlement systems, while America debates rate semantics, should concern every long-term saver. Industrial slowdowns may pressure silver temporarily, but structural monetary distrust is becoming the larger force underneath global commodity pricing. Next, Matthew Piepenburg unravels why silver shortages may overpower recession fears despite weakening industrial demand.
Which is really 5 years of a consecutive, now at this point, really 1 billion ounces of silver and a supply deficit after compounding at 200 million ounces per year. That supply and demand mismatch is extraordinary. That's stronger than even the impact of lower demand from the industry if we see a recession. I think the military needs alone for silver would still keep a natural demand despite a recession. And it's not just U.S. markets. Even if we have a global recession, you're going to see in Asia and certainly in China with solar panels and EVs. And again, silver far more in use in the military. That's why we made it a critical minerals on the critical minerals list last year. As we're wasting a lot of our missiles right now, they have to be rebuilt. The silver is still going to be a part of it. I think the demand for silver and the supply and demand mismatch will be greater forces, bottom line, than any industrial demand slowdown in a recession. But certainly that can affect supply and demand. And certainly the paper exchanges can affect the price. But supply and demand, just like everything in the end, finally gets the last laugh. I'm not here to time it. Many in the silver space are far more bullish than I am, but I'm easily at $200 silver, and Egon is extremely bullish. And others who track the technicals and fundamentals aren't worried about trying to time this direction. They're just sitting back and letting the dollar shoot itself, and letting the US shoot itself, and letting paper money shoot itself.
Silver demand keeps rising even as economists warn manufacturing weakness should already be crushing prices by now. Matthew Piepenburg's argument suggests investors are underestimating how military demand, solar expansion, and persistent supply deficits can overpower recessionary slowdowns in industrial activity. A compounded deficit approaching 1 billion ounces changes the equation from cyclical volatility into structural scarcity. Investors focused only on short-term pullbacks may miss the fact that physical availability matters far more than temporary paper pricing pressure. Next, Matthew Piepenburg reveals why institutional traders remain quietly bullish on silver, despite mainstream recession fears dominating headlines.
We're just patiently waiting for silver and gold. Silver will move in a beta trade to gold in a bull market. Gold's bull market is just beginning. So we're not really too worried about the timing. There are forces, of course. We've seen backwardization in the futures market on silver with other indicators. It's very bullish on silver. We look at what SocGen traders are doing. I talk to traders, what they're doing. Their long-term play here is very bullish. But again, if you're a swing trader, a day trader, an arbitrager of precious metals, best of luck to you. I'm no help to you. We're long-term preservationist thinkers. We're long-term cynics on paper money, and that is Ray Dalio's point. If you understand economics and history, you'll have no problem gaining faith in gold and silver. But certainly there can be headwinds and tailwinds as this process moves. None of these metals move in a straight line. But against the dollar, all commodities in general are just ripping in price because the dollar's gotten weaker. But gold and silver are commodities 90% of the time, but they're money 10% of the time. And we're in that moment right now where gold and silver are monetary metals at this particular turning point in history. So not only its commodity profile, but silver and gold's monetary profiles are going to have a heck of a run in the next 5 years. And already.
Backwardation in silver futures historically appears when trust in future delivery begins weakening beneath the surface. This is where Matthew Piepenburg's thesis shifts from commodity speculation toward monetary realignment, where gold and silver start behaving less like raw materials and more like alternative currencies. Long-term institutional positioning remains bullish because the core driver is not industrial demand alone. It's declining confidence in fiat purchasing power globally. Traders chasing short-term volatility may miss the larger transition already unfolding across sovereign debt and currency markets.